Hello, YouTube. Could the S&P close up by 24% by the end of the year? Well, here we're going to be looking at a pattern that has only happened 5 times in the last 150 years, or really an update to the 12-month bearish engulfing pattern that we shared on December 24th of 2023, and how 3 out of 4 times is followed with a green year. So is history going to repeat itself again? And as we look here too, the stat going into the end of the first quarter, as we're closing out the second one here, it tells us that the full year has never been lower after the S&P returns more than 7% in the first quarter. Specifically, the average return has been 23.1%, and the median has been 24.7%. So that's really what we're going to look at here. We're going to look back to the periods where this actually played out, and we're going to try to understand what history tells us, because those who don't understand history are doomed to repeat it. And as we look forward here, I'm going to look at, we have the 1890s, we got 1930s, we got 1960s, 1970s, and 2020. I want to focus on this period right here. And I'm going to focus on this one period right here because what it tells us is that we're either going to go back up to the relative high or go to new all-time highs, or we're going to dump down. So we've not dumped down yet. And if we think about this 24% that I put in the title of the video, that is what we're going to do right now. But I'm going to ask you for a huge favor as we're getting started. If you could please consider smashing that thumbs up and subscribing to the channel, I would greatly appreciate that, because we put out stock market videos every single day, and we want to give you updates throughout the rest of the year. All right, so what I find interesting here is that first thing I want to point out is just that I notice a W inside of the pattern from the 1940s leading to the 1960s, and then we have something similar here in the 2000s leading up to the 2020s, where we melt to a new all-time high, we melt to a new all-time high, but then we have a period where we go sideways. So that period where we go sideways might be what we're doing now. Ray Dalio calls that the lost decade, but that's the first thing I want to look at here. So the next thing I want to look at is that when we look to the 1967 year, we're going to remove all the trend lines. And what do we note as we get nice and close for those boomer eyes? What do we do? Well, we form a higher low, we go to a higher high, and we actually close over the previous candle high, which means that we actually go into new all-time high territory. We go marginally higher, get a little bit of a lower low, and then we grind up even more. So I think there's still a lot of growing pains through the lockdowns we experience, which have not been fully materialized around the world, including America and beyond. But if we look here, that one simple pattern tells us, hey, we can go to new all-time highs. Okay. Now, the second thing here we want to look at. So if at the close of the first quarter, we normally, if we're up more than 7%, which we are so far, 7 here, still a question mark for where we're going to close the year out. What would 23 to 24% for the current year we're in right now look like? And would it look something similar to that 1960s, 1970s pattern I just pointed out? So we're getting nice and close here. And just note that this is going to be a 12-month chart, which means this is going to be for the entire year. So far here on the year, we're up by about 16%. If we were to shoot up by that 23 or 24%, oh my goodness. 24% takes us up to 4,800 on SPX. And if we get to the all-time high, we're looking for about 25.5%, which means I could see a way of us getting there. So I showed you the fundamental reason, which is the pattern. I showed you the gains return, which is that 7%. And then the last thing I want to look at here is just what was the return from 66 to 67? 21%. So 20+%, we go to a new all-time high. And could we do that again this time? Let's see what's actually driving the market now to see whether or not there's any evidence to support our thesis. Nasdaq has its best ever first half of the year with a nearly 40% gain propelled by big tech and AI hype. So if this hype has more than just hype, it's probably going to lead to higher highs. And Tim Cook here flashing us a nice little peace sign, because Apple just closed out with a $3 trillion market cap, the first company to ever do it in history. We're going to look at 2 more quick patterns here, and then we're going to fast forward and see what the charts look like right now. But I really want to give an update to that chart that I laid out here. So what we're going to do is actually zoom in here to a monthly chart. And just remember that we're looking at this monthly chart. Here we're looking at SPY, which is the one we're primarily looking at. But I want to focus here, and we note the breakout. So after we broke out, the trend has changed, which is what we spend a lot of time talking about this week. When the trend changes, if you're aware of it, you can make money. But if you're not, it can really hurt. And the short sellers really paid attention because they've now reduced their short position from June to close out the month here by more than half. We were at 434,000 contract short. Now we're at 208. So they are fueling the rally. And something we pointed out before too was just that, let's see if that chart will load up here. Every previous time there's been a massive short, they double down. It usually leads to the market going to new highs, like in 2016, like in 2019, like in 2020. And is it going to happen again here in 2023? Well, we had the 2022, we had the lower low where they doubled down, and now they're covering it. So let's look and see what these shorts are doing, because there's two things I'm looking at here in the seasonality chart. So the first thing here is that in June, we close the month out with a 1 cut, 2 cut, rally back up, and then just moon for July. The second part is we've been talking about the second dip potential. So as we look here to our monthly chart, just please keep that in mind. I'll give you a really brief update here. So note we got one move down, a small dead cat bounce, a second move down, and then a move up to form some kind of a W. So is that W close enough to what we're looking for here in June, where we don't look back from here, we rally back up, and then we just go higher? I'm not sure. We're back up at the highs, which would mean that if we're following the seasonality chart, we're probably already right here where the melt higher should just really start progressing and accelerating. That's the first thing I would note. The second thing I would note is that if we're going to go down for the secondary cut, I could see a way of that happening as well. I'll show you that now. So let's actually go back here to our monthly chart, understanding that we've broken out and we're closing right around that high, which for me would signify that we should at least get some upside push, some thrust, right? That's what should be happening, some continuation or pressure getting released. So what does that mean? Well, I'm looking back here to the pattern where we compared to at the beginning of the year when we gave our 2023 prediction. And we have a pattern here. We go to new all-time highs. In this case here, we go to new all-time highs. We crash land. This one's a little bit longer, but we get a couple of nasty candles. So here we note that we have the reversal candle, which leads to the test on the 50 moving average. Here we note the red line starts on that wick, which leads to the test of the moving average. And what happens both times? Well, you can see the yellow box. We bounce, digest the move, and then go to new highs. We bounce, digest the move, and then we go to new highs. So if we look here at a hollow candle, it also shows us an expansionary period, something we've been talking about consistently. Here we have 1, 2, 3, 4, 5 hollow candles. So far in 2023, we got 1, 2, 3, 4. All right, so it's like looking pretty close. So if we're tracking history, there's a lot that looks similar so far. Going back here to full candle, so it's a little bit easier for you to look at. The next thing we want to look at here is just the actual pattern. So here we're going to be looking at that relative high, the retest of it, and where we are right now. So we got our relative high, we come back up to retest it, we close over it. All right, so that's matching so far. Close over it, we close at the high of the candle, which leads to a move higher, and then we go red. So if we're going to go green and then we go red, it seems like a pretty simple pattern for us to look at. If we're green on the month, which means we're above 44.50 going into July, hey, gravy train continues. We can keep going higher. We can keep squeezing. We can get even more extreme greed going to 90, maybe even closer to 100. We're getting pretty close to forming a higher high here at 81. We're back here at 80. So if we can push up, that would lead to a squeeze like the seasonality chart implies. And like the breakout here also implies. So the second thing I would just note here is that we get a little bit of a warning. So we're going to zoom in a little bit closer to 2020 and then just try to understand what happens inside of this flag pattern here, because it really is that. We get a bearish engulfing candle, but don't close below the low. We get an inside bar, and then we break bullish, which really means it's a trap. So I didn't put the word trap in the title because we'll talk about that if we get the failed breakout. But here's what happens. We close at the high of the month. We get a push higher, which means we form a higher high, and then we get back below the monthly high here. That leads to a consolidation. So I think that might be the second scenario as we go into earnings season in July. We go into that next rate hike from the Fed. I think that could potentially happen. If we stay green on the month, we just watch for weekly higher lows and higher highs, as we've talked about a lot here. So if we go back to our weekly chart, we look at hollow candle signal the expansion is continuing, not just for a weekly chart, though, also for a monthly. And then lower lows are a warning. So we take that same thing here where hollow candles signal the expansion and a lower low is a warning. So we got our lower low this week, but it ended up being a bullish engulfing candle. So let's use that same thesis here on our monthly chart. Let's actually go back here. Let's go to this one. Let's go to our monthly. So if we now look here, let's flip it to hollow. All right, expansion, 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 expansion. There's the full candle. There's the full candle. Then we go back to a fresh expansion. If we now look over here to 2022, 2023, what do we have? Hollow, 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 hollow. So as long as we keep printing hollow candles, we should keep going higher. And for us to print a lower low, we're going to have to come all the way back down to 41.71 or puke up more than 6% of gains, nearly 7%, which means we're only going to really know the bears are in control when we get all the way down here. But that warning is going to come from us going green on the month, which I think is very likely going to happen, and then slipping back below, just getting back below where we closed at 44.50 or going back to red in the month. It's really that simple for me right now. So I don't want to overcomplicate this video. That's the dominant pattern I'm looking at right here. It looks eerily similar to me. We got that a solid expansion, and we could notch in a fifth candle of back-to-back gains like we did in 2020. I'm just watching for it like that seasonality chart implies. So now if you look over here to a shorter time frame, here's what I want to keep in mind here. So what I want to keep in mind is that we're closing out the month, and we're closing out at 443.28 on SPY. We now have a few gaps in the chart as well, though. So we have a gap here that was established on Thursday, Friday into that core PCE number. We also have a gap down here going back to July 6th. So we're able to gap and go. I was a little bit surprised by this gap and go. I'll be honest. I'm not going to lie. I thought we were going to fill the gap. We didn't. We went higher. Window dressing happened. People wanted to buy. So, right, pop, flag, pop, and then there's the dip, strong bounce off 432, and now we're right back here to our highs. So the question is, are we even going to fill this lower gap? And the reason I say that is because if we do fill this lower gap here, it means we're going to be getting a test of 438. It's only about 5 points lower. But what that would do is it would actually get us to a red month. And if we look back to here, what that would mean is that we should be going back down to red on the month. So again, big if here, because it hasn't happened for the last one. If this most recent gap does if we go green, and then we back test the gap and we bounce off this area and then we go higher, like, hey, everything looks good. We got a little bit of a lower tail on the month. We go back up to new highs. But for the bears, what they want to see one more time is they want to see this area break. So they want to see this area come back below, fail to break out like what happened on the weekly. So go higher, come back down, fill the gap, and then just go down to fill the lower gap and then just resume lower. That's what bears want to see in July. It would invalidate the seasonality chart, and it would be something new that we haven't seen. And we've been talking a lot about the leadership we've seen so far this year, or they're calling them the Fantastic Seven, or the FANGs, right? The $1 trillion company. 1, 2, 3, 4, 5, 6, 7. We're talking about Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta. Those are the big dogs. So what we want to do today is look at whether or not there is breadth coming into the rest of the market, or are other sectors or groups going to finally start to participate? Because we look here at a year-to-date chart, it looks okay, but a 3-month chart actually looks a lot better. There's more breadth, there's more depth, and it looks more healthy. They call that widening out, where the rally is not just isolated to these big cap tech names. So I want to look here at a couple other charts, notably here on RSP, because we're noticing that the volume is preceding the price. That's what we normally see. People are really loading up on RSP, which is equal weight S&P 500, which just means that they believe that we're going to see that widening out. Green volume doesn't always lead to higher highs, but the price action does. So this looks like capitulation. We're really getting a push-pull here off the 50, and now we're actually getting that push higher. So there was a breakdown last week, and then boom, right? We got that full reversal this week. It looks like it was a trap for the bears. Bulls came in, they bought the dip right into the end of the quarter. So this one here looks pretty good. I would note we are right around key resistance, though. So we want to poke through about 150, and we want to take out that high we established at the beginning of the year to signal that all stocks, not just the Fantastic Seven, are looking like they're going to go for even higher highs. I want to look here at a couple more now. DIA. I want to look at the Dow because the Dow is still a pretty big component in the market, struggling with those same relative highs here. So hit it once, twice, 3, 4, 5 times now. It's hit it 5 times. So every time it's hit it, It's not been able to rally, but we are noticing we see an inverse head and shoulders inside of here. We are trending up. We got to bounce off the 50. We're still trending higher. It says all systems go if the rally is real, right? So if the rally is real, we should keep going higher. And then finally, if we look here to small cap stocks or the Russell, what do we note? Well, high, lower high, lower high. It's forming some kind of cup, maybe with a handle. We got a death cross here. So small caps need to run. They need to form a higher high. They need to get over 200. I'm using that word intentionally here, need, because a death cross just means there's lagging momentum. Like a golden cross here leads to higher highs and new all-time highs. A death cross will usually lead to more downside. The last time we got one is actually all the way back here to 2008 on the weekly chart. So it took some time for it to fully take effect, which might be happening here. So let's just make sure we're not getting a little bit too rosy-eyed looking at this market with all of the upside potential that we're seeing. And then I want to look at, I think, two more charts here. So I want to have a look here at ARK, because ARK is so close to doing that same thing here where we have, let me actually see here. We got our relative high here at 45.46, and here we got 45. So we haven't quite gotten there. We got the high, and then lower high. And I'm looking specifically at small caps in the Russell because, man, people just hate these sectors, especially ARK. So if these things can't form higher highs, well, yeah, we're playing great defense. Low, higher low. Maybe that's the higher low. But we're not forming those higher highs, which means we're not going into expansionary territory. Hit the 50, back off, gather up steam, get over the 50, but we need to form that higher high. Even in these last three candles here, we didn't quite print that higher high. In closing at the high of the candle, I would expect this is going to break out if we're truly going into a risk-on rally into July. That's the other one I want to look at here. I think there's two more. So we want to look here at the DAX. Looking at the DAX, this is going to be very interesting because as we look here to, I'll actually throw a box in here, make it a little bit easier to see. We look here to the all-time high, and we note that we made it to new all-time high territory. So, right, every time new all-time high led to a big drop, build up lots of pressure over many years. We tap it here in May, try to get higher, lots of lower tails, but we're not yet above that 16,300 area. Need about another 1% for us to get there-ish. So if we can rally 1 more percent and then go to new all-time highs, that'll become more of a frictionless rally. Something we noted about Apple, that after it actually gets to new all-time highs, well, it went from 180 to 193. We notice the same thing here with NVIDIA, where once it finally gets to new all-time highs, well, it hasn't really looked back. It's pretty strong here at 423. But we're not quite seeing that from the other companies. We note here, let's actually see if we can look at a 12-month chart. Same thing here for Microsoft. So new all-time highs, it's digesting that move, but not quite there. And then other big cap stocks like Google, these have room to run back up to their real body or the all-time high. And we need to see participation from these stocks because if they're the Fantastic Seven, they better continue to be fantastic. Looking here at Amazon as well, Amazon has that same potential here for real body to go back up here towards its all-time highs. Finally, what else do we got here? We got Tesla. So Tesla broke through the real body spell where it found a lot of resistance. It can shoot back up another $100 and drag the NASDAQ and the S&P even higher. Maybe Tesla has some kind of AI play they're going to put, right? We know they're working on some stuff. Hasn't really been talked about too much, though. And then finally, going to Meta. Already pretty close, right? So if you've been impressed by Meta, well, are there other companies out there that are better than Meta? Maybe. I think so. And then let's look here at, I think I want to look at two more charts. So the other charts I want to see here are FXI, just to make sure we get a good grasp on the whole world. China right now looks pretty crap, right? It just can't catch a bid. So if we're going to be going into a global risk-on rally, well, these things have to participate. They got slammed down 7 last week. They dead cat bounced 1% this week. They don't look very strong. I like to see this thing actually pointing up because as the second biggest economy in the world, if they're not buying or if their economy is not doing hot, that's likely going to have a spillover effect into Europe and potentially into America. Looking here to emerging markets, this is what I would like to see from China. See them actually reclaim the 50 moving average and then actually launch pad off of it. We're not quite seeing that yet. So we need to see that rally widen out to the Russell, to ARK or higher risk names, to the rest of the world like FXI and emerging markets. And that's really what's going to get me more convinced this rally is real. We should see banks, we should see energy and other names participate as well. We can also look here to NYA, which is going to be the New York Stock Exchange. And we note this chart looks very similar to the others, where we have that really tough resistance we just can't quite get through. So at roughly 16,000 points here, right? Hit it back off, hit it back off, hit it back off here. That's the fade. We're going to need to gather steam up here again to finally break out and make those new highs. I think there was one more chart I want to look at here, and leaving it right till the end because the bulls are really celebrating here. And as we all know, there ain't no party like a bull party. But here's the one thing I want to leave you with. It's the other rally that is happening that you might have forgotten about. There's the bond market and there's the stock market. Generally speaking, when bonds go down, stocks go up. What's really odd here is that we're seeing stocks up and we're seeing yields up, which means the bond market says, hey, we kind of believe Jerome Powell, higher for longer, hike now, hike in July, hike in September, hold for longer, don't do anything. Stock market's like, hey, I don't want to believe it. I'm drunk on these AI gains, buddy. So here we have the crash from the SVB. There's the dip buying, and now we're actually on track. Actually, that is the strongest weekly close we have, going all the way back to 2007, the glory days, before we had that fat fade. So there's definitely some warning signs out there, but so far the market is discounting them and choosing to chug higher. So last weekend, we left you with a video, The Stage is Set, that is now queued up here on the left-hand side if you want to go back and watch it. If not, thank you so much for watching. I wish you a terrific Canada Day and a terrific 4th of July weekend. Thank you so much.